We don't need too much for that size. Not open to the door. ಅಷ್ಟೇನಾ ಚೇಂಜ್ ಮಾಡ್ತಾರೆ ಅಷ್ಟೇನಾ
But we are now on the threshold of some new challenges like geopolitical disorder, rising inflationary pressure through elevated commodity prices, higher interest rate, persistent supply issues, pent-up demand, and the list goes on. To address these very concerns and drive a better insight on the way forward, we have with us this evening industry veterans to share their views on current market and the way forward. Please join us in welcoming our panelists for this evening, Mr. Tridip Bhattacharya and Mr. Amit Tripathi. Tridip is the CIO Equities Edelweiss Asset Management Limited. Tridip comes with over 2 decades of experience in equities investing across Indian and global markets. His previous assignments, including building a market-leading PMS business at Axis Asset Management, as Senior Portfolio Manager of Alternate Equities, and alumnus of IIT Kharagpur and SP Jain Institute of Management and Research, Mumbai. He has served as a Portfolio Manager at State Street Global Advisors and UBS Global Asset Management, London. To detangle the fixed income jigsaw, we have with us Amit Tripathi, CIO Fixed Income, Nippon India Mutual Fund. Amit has been with Nippon for 14 years. During this period, he has evolved into a stellar portfolio manager, combining experience across yield curve and robust credit evaluation skills. He has successfully managed various fixed income and hybrid funds, which have been recognized for superior performances both nationally and internationally. This panel discussion will be moderated by Mr. Vinay Joseph, Director and Head of Investment Products and Strategy, Standard Chartered Bank. He is responsible for formulating the bank's in-house views and investment product propositions. Vinay holds a master's degree in economics with over 15 years of extensive financial markets experience spanning across ASK Wealth Advisors, IDBI Federal Life, JM Financial Institutional Securities, and JP Morgan Institutional Equities. Without much ado, I hand it over to Vinay to take forward this session for the evening. We have placed the Q&A card on each of the tables and urge you to use the same to ask your questions. Our colleagues will collect the same and share it with Vinay to have it addressed with our panelists. Thank you. Vinay. May I request Amit and Tridip also to join us, please. Thank you.
Opening remarks on how they see the markets and maybe starting with you, Tridip. It's been a very volatile environment for equity markets. So how do you see the year going ahead, and where are the segments where you see opportunities and what are the risks from an equity market outlook perspective?
Good evening, everyone. First, thanks for inviting me on your very interesting panel discussion. And I must admit that I'm doing this panel discussion, or not this, but in general, a live panel discussion after practically 2 years. So from the times where we are used to this virtual session. The live sessions are far more interactive and hopefully live, because we can get a feedback whether what we are saying it makes sense or not. But I think you asked a very pertinent question with regards to volatile times. And I would probably kind of divide my comments into two parts. One is three parts. One is India in the global context. Second is India in the context of India over the last 10 years. And finally, the market outlook in terms of the way, the segments, etc. So, India today in the global context, I would say, is far better placed as compared to what we have seen in the last 10 years. And I think I say this not because we are sitting here discussing Indian markets and stuff like that, but if you really kind of look at the issues that the global markets are dealing with, if we start with the United States, today we saw the inflation rate that just came about as I came in here at 8.6%, which is the highest that they've seen in 1970s. And if you read the history of markets, around that time, Paul Volcker, a gentleman who came about going hammer and tongs at inflation and didn't care too much about growth. So, and secondly, this is an issue that they don't have a recipe for coming out of this sooner than anywhere else. But if you compare this situation with that of India, for instance, just to kind of bring India in the context, you will see that today the inflation is an issue in India as well. But the inflation issue that in India that we are facing is something that we have seen in 2015 or thereabouts, so we've seen worse time. In other words, here the situation on inflation count is more manageable than what US is grappling with. Of course, we will see the repercussions of the inflation being higher there and whatever measures they take, but domestically, the situation that we are seeing in India is a lot better than what we are. If we cross the pond and look at Europe, then very clearly what you see there is that almost 50% of their energy needs actually come from Russia. And as you know, Mr. Putin has all of a sudden turned off the tap of energy onto that. So they are really grappling between keeping the lights on versus dealing with the recession. A far more, in my opinion, grave situation to be in. And if I were to sort of make a guess, as an observer, as the first country or set of countries that might get into a recession, it might be European rather than anyone else. So that's Europe situation for you. If you move to China, we have a situation where the real estate sector, post Evergrande, has never really come out trumps. And so much so that while the rest of the world we are seeing a gradual withdrawal of liquidity happening, in the case of China, we are actually seeing pumping in of liquidity to get the economy going. So the economic situation in China is also kind of looking a little shaky, so to speak. If I add on top of that COVID-related concerns and the fact that we are not yet completely out of it, I think the situation is quite grave. So, having done a quick survey across the globe, coming back to India, our problem is only one: oil. Oil north of $120 means problem for us. But when I was, and on top of that, we are also reading under the effect of supply chain issues and all of these things that have come about, which made inflation look the way it is, and which is why in India also you saw a rate increase happen. But in my opinion, if you look at the content of inflation, while clearly it is kind of lingering on for a bit longer, but over the next 3-4 months, you will see the pace of inflation, based on what market pundits are saying, come down a little bit. So inflation is an issue in the context of India, but a manageable problem, and we have to deal with it. It's not a pleasant place to be in, but inflation is work better than having a deflation, let me put it this way. So, in other words, in the global context, today if I look at India, it is very well placed, if I may put it that way. Part of this is also reflected in the valuations, where India today is quoting at roughly, last time when I checked, anywhere between 25 to 30% premium to most of our Asian and other emerging market players whom we tend to get compared with. And if you look at market performance today in India, even YTD versus that of United States, you would probably kind of be globally hands down. So on net balance, there is a reason behind the outperformance that we have seen globally. There is a reason behind what we have seen in the last part, because overall, whether it is bottom up or top down, our economic situation looks a lot better. And hence, I think for investors who are invested in India portfolios, there is a reason to be relatively feeling better off. I use the word relatively because, at the end of the day, the economies are related. So if US is facing a problem, we will also face a problem. The extent of the problem might be a little lesser. So that's the first part which I wanted to talk about, India in the global context. Second, India in the context of India over the last 10 years. And I would say that there are three things that are happening in India today which make me quite confident that the medium term, which is the next 2 to 3 years, from an economic context, still looks quite constructive. So those three things are, first of all, I think there is a decent chance, first time in the last 10 years, that we actually get a capex cycle in India. This is something that we have been longing for a while. I mean, I think if you regress your memory for the last 10 years, I'm sure you would recollect that majority of the capex tends to be done by the government, whether it's road building, infrastructure, or bridges and whatnot. And by and large, over the last 10 years, the private sector has been absent. In that context, when we did a survey as to, what is the capex intention of various parts of the economy, for the first time, we noted that of private sector capex intentions, which is intention and in the sense that this will come over the next 3 years, are almost about 6 times that of the public sector capex intention. This is the first time that I have seen such a data roll by in a good while. So fine, I mean the rates are going up, fine, there could be some corporates which might have overestimated the demand, but even if we get somewhere around 50 to 70% of the number that we are talking about, I think this time around we will see a good capex cycle come about over the next 2 to 3 years, something that we haven't seen before, I mean in the last decade or so. The last time we saw something like this was basically in early 2000. Where there was a lot of infrastructure creation. Since then, we haven't seen that bit coming about. So that's the first thing that I wanted to talk about in the context of India over the last 10 years. The second thing that I would say is household capex demand, which in common parlance we call real estate. As the data crumbles, when we look at the data, for the first time in the last 10 years, we are seeing inventories across India bottoming out. Now, for followers of real estate, I'm sure you would know that real estate generally is a 7-year cycle. And it's an important sector in the context of economy because it generates a lot of ancillary employment. People in segments of the society which have got badly hit, particularly during the course of COVID and whatnot. So, I was saying that the inventory in the real estate sector is bottoming out. And this is generally the first stage of recovery in real estate sector. In the second stage, you have prices going up, then you have the exuberance, and finally it falls away. So in that context, we do have 2 or 3 years of real estate demand that might follow us in the subsequent 3 years. Again, followers of Indian economy might note that since 2008, 2009, inventories have gone one way, which is up. And actually we have seen a lot of bad blood come through in the case of real estate sector post the RERA introduction. A lot of consolidation, a lot of vendors kind of didn't have to do a forced sale. But good to see that the inventories are finally bottoming out, and we see the real estate sector coming out of a bit of a slump that they've been into. So that's the second part. And the third part is, finally in corporate India we are seeing double-digit salary increases. While some of you may work, some of you may be businessmen here, but it's brought a lot of cheer after a lot of time in the Indian corporate sector. So far, over the last decade, we have been used to a situation where the salary increases have been in the range of mid-single digits, just about to cover the inflation. And according to the survey, now over the last year, the salary increase has been to the tune of, on an average, 15 to 20%, and fairly broad spread, not just in IT services, but also in several other parts of the economy, which could be called as white-collar jobs, and ultimately can drive spending. So clearly, while in the near term, everything gets clobbered under the high inflation, high oil price, and spending is kind of muted, but I would surmise that over the next 9 to 12 months, there's a decent chance that you will see consumption spending also make a comeback over time. So just to kind of talk about so we were talking about India in the context of the last 10 years, and we said that the three things that I see as of now are something that we haven't seen in the last 10 years and are quite constructive. I mean, first of all, a capex cycle coming about. Second, we talked about the fact that the real estate sector is bottoming out. And third, that salary increases kind of are finally coming through. So all of these actually, coming back to the question you asked, makes me constructive on the equity markets from a 2 to 3 year perspective. And that's how, as portfolio managers, we actually strike our portfolios. The near term, though, looks a little murky. And this is a view that we've had since the beginning of this year, that if you look at the next 12 to 15 months, i.e. from Jan 22 to March 23, broadly speaking, should be seen as a tale of two halves. Where the first 6 to 9 months, which is kind of heading on to July, August, September, that time frame, first half would be quite volatile. Not negative, not bearish, but volatile. And money making should not be the top priority. The top priority should be to use the declines to kind of increase exposure to equities. And the second half onwards, the medium-term picture that we talked about with regards to the 3 points that I mentioned of capex cycles, this, that, the other, will actually gradually start to materialize. So I think so far we would kind of still stick to the same view that the near term will be volatile, and I think we are probably, as we speak, somewhere around the peak of inflation, or there or thereabouts. Nobody's an expert on inflation. Ultimately, it's as the data crumbles. But just by the base effect, it might actually start to trickle down a little bit. It will be less of a problem than what we have seen earlier. But we are in and around, as we speak, in June, July, August. We will probably see the peak of the issues that we are facing on the macro front. Also, heading into the next quarter earnings season, we will also see probably the worst of the impact of commodities on the margins, and after that things should gradually actually start looking more constructive from an equity standpoint. So we are suggesting investors to kind of use this time frame overall to kind of avoid lump sum but go more in tranches and that sort of an outlook, and see 2022, a better part of 2022 to be an investment year. And this is what we've been saying since the beginning of this year. We continue to say the same. After a stupendous year that we've had in equities, it's okay to have a more sedate year, so to speak. But we are constructive on equities from the medium term, from the 2 to 3 year perspective, and we think that this is particularly in places of in times when we have inflation, equities is a good place to be, both as an inflation hedge and also with regards to the upgrade story that we are seeing unfolding in India. So I will stop here and back to you.
Thanks, Tridhi, for the opening remarks. Amit, usually in times of equity volatility, people go into the safe haven of debt. But if clients look at their portfolios last 6 to 9 months, debt has not proven that. Where do you see the debt returns over the next year or so, and which are the segments where you think there's opportunity?
Okay. So I remember the interview came out in June 2020. There's this economist called Russell Napier. A lot of us have heard the name. He talked about a problem of inflation on the annual at that point in time. Obviously, it was ignored. He came back in June 2021 and again talked in the same breath about the problem of inflation. By that time, the market had started recognizing it. It was just that it was not getting priced adequately enough. Getting to the antecedents of the problem, the antecedents of the problem were very simple. When was the last time we saw in India the government and the RBI both loosening their belts? That was after the great financial crisis of 2008-2009. All of us remember Manrega from those days. What happened after that is also well known. 2010 to 2012 was one of the highest inflation periods in the last 15 to 20 years. Something similar has played out at a global scale this time around. All the central banks, all governments opened their purses at the right time. Obviously, it was a time for survival. Everyone was thinking about survival at that time. Possibly what went wrong was that when you had to retrace, people were delaying the retracement per se. Right from the Fed to the RBI, I guess the process of retracement got delayed by at least 6 to 9 months, if not more, and which is where the entire problem got manifested in the manner in which we see today. That's the bad news. The good news is that people recognize that it has happened. In fact, whoever we have spoken to in the last 3 to 4 days since the time the last monetary policy came out, the common refrain is that the best news to come out of this monetary policy is that the RBI and the markets are on the same page, which is very important because as market participants, as an investor, the last thing we want to happen in fixed income specifically is a negative surprise. And when the central bank and the markets are more or less on the same page in terms of both their thought process as well as in terms of the potential rate actions, the pricing in the markets tends to get very adequately and properly done, which is what has happened in the last 2 to 3 months. We have reached a point where markets have factored in not only a number of rate hikes but also a fronting of rate hikes. If you actually look at the market pricing across the curve, you look at the two most liquid curves in India. One is the government securities curve and second is the overnight index swap curve. Both of them tend to be hinting at extremely sharp and fast rate hike cycles. But the good news is that both of them seem to be thinking that it will all happen during the course of this 12 months and it will start after that. In terms of actual numbers, the way the cash markets are pricing it is that the repo rate, which stands at 4.90% today, will end up somewhere close to 6 to 6.5% over the next 12 to 18 months. The swap markets actually go up to 6.75 to 7% as well. But the limited point is we don't know which of them is correct. We don't know the extent to which they are correct. What we know is that an adequate amount of tightening has got priced in. And after this policy, it is also very clear that the RBI is going to follow suit, which is again, like I said, good news, because now you are going to see something happen in a manner and over a span that is well anticipated and well priced in. So that's half the problem solved. The second issue is where is the market today in terms of pricing and is that adequate? Because at the end of the day, we might endlessly keep on debating on what is the peak inflation rate, what is the peak repo rate, etc. What matters to us as portfolio managers and you as investors is what is the return on the portfolio. And that is where this concept that is very clear from a fixed income perspective of a holding period return comes through. Now let's start by recognizing the fact that irrespective of which type of product you put in money, as long as you are not running very high degrees of credit risk, more than 90% of your returns are always shaped by the carry of the product. Simply saying that, the way we relate to fixed deposits, that a 5% fixed deposit gives us a 5% return and a 7% fixed deposit gives us a 7% return, that's exactly how debt markets also operate. The fact that the regime of interest rates, even before the RBI started hiking rates, has shifted by more than 2% in the last 1.5 years, means that the carry across fixed income portfolios have moved up significantly. Your overnight rates might have moved up from 4 to less than 5%, but something like a 3-year government security has already moved from 5% to 7%. Something like a 10-year government security has moved from 6% to 7.5%, so on and so forth. And this is as much true about government securities as about all other parts of the market as well. So that's the second bit of good news. The first being that RBI and markets are on the same page. The second bit being that the markets have baked in a reasonable amount of rate hikes going forward and have priced in a reasonable amount of rate hikes going forward, which essentially means that if you go wrong from here on, the penalty that you pay for going wrong from here on is going to be much lesser than what was the case last year. Which again, in terms of holding the return, means that if we are wrong and the RBI actually ends up more than 7% on the repo rate, or if we are wrong and inflation actually peaks out much later, if we are wrong if average inflation for this year is not 670 as the RBI puts it, but 7.25, even in those circumstances, the 1 year, 2 year, 3 year returns that you will get from commensurate debt products will look much better than what they were looking last year. So that's the second important thing to consider. The third thing obviously is that we have to accept the reality as it stands today. And the reality is that globally and locally we are in somewhat uncharted territories as far as the macro environment is concerned. And when you are in uncharted territories, you only take the amount of risk that suits your risk appetite, and second, more importantly, you stay the course. To give you a very simple example from a bond, when you buy a 25-year bond, you pay 100 rupees of principal today, assuming there is a 7% coupon. You actually over the next 25 years will get nearly 200 rupees as coupon. So what you are getting as coupon is actually much higher than what you paid in terms of principal. As portfolio managers and as investors, we are always worried too much about mark to market, right? That if interest rates go up, I will lose money on a 25-year bond. But how many of us think this way, that if interest rates actually rise, the fact that I am getting 200 rupees during the course of this life of this bond, I am going to invest or reinvest this 200 rupees at higher rates than what I invested the first 100 rupees at. So ultimately, fixed income actually works in a slightly different manner if you stay the course rather than getting worried about mark to market. If in this bond you entered at a yield of 7%, but your coupon got reinvested on an average at 8%, your end number will be much higher than what you entered at. So that's how fixed income typically works, and which is why I said that there is more good news from a potential return perspective that exists in the market today as compared to what existed 1 year back. Obviously, it has come at a cost. It has come at a cost of mark to market that we have seen in the last 12 months. The market also to some extent under-anticipated the inflation risk, but it did anticipate somewhat rightly since the mid of last year, if not the beginning of this year. It's just that because the numbers have moved much ahead of market expectations, the market has had to reprice itself not only once but almost 3 times in the last 1 year. Now you have reached levels where, unlike 2021-22, where there was little noise around inflation, but the return it was seen in portfolios, in 2022-23 and beyond, possibly there will be more noise around inflation and RBI action, but lesser impact will be seen in portfolios. And I think that is the most important thing for us to recognize when we are looking at investing. Also, in the same way to recognize that we are in the midst of a problem that we have not seen in the last 15 to 20 years, we have not dealt with in the last 15 to 20 years. Recognize it as such and only invest to the extent that our risk appetite allows us. More importantly, to marry your investments with the time horizon of the product, because at least that ensures that the current high carry that fixed income offers, starting from the government securities downwards, at least remains intact over the course of your investment. And I think if we are able to make that kind of a return, we would end up being reasonably happy with what the portfolio would have generated for us. So that's broadly our thought process. In terms of specific products, we do feel that the market has baked in a reasonable amount of rate hikes. Like I said, 6 to 6.5% of repo is more or less baked in. The shorter end of the yield curve, which is products that operate into the 1 to 5 year space, typically get impacted much more by rate considerations alone. So that part of the segment, having baked in these type of considerations, looks reasonably priced at this point. The longer end of the yield curve, while looking very, very attractive from a yield perspective, maybe there is some more time to go before investors start feeling confident around that. Not because the absolute yields are unattractive, but because the volatility around the macro environment is likely to continue for some more time, and there are many additional elements also which can impact that part of the yield curve beyond the rate mathematics. So this is not a market where one shuns away risk completely. This is a market where one recognizes the fact that carry has improved meaningfully. I can take some incremental degree of risk than what was the position 3 or 6 months back. But I have to be alive to the fact that since we are still in uncharted territories, I need to stay for a duration which is in line with the risk profile. Thanks.
So, I would request the SCB representatives to just please collect the cue cards from the clients so that we can take the questions. Meanwhile, I have a couple of questions. First to you, Trideep. You spoke about the entire scenario of how you see equity markets. The question here is, in the last 1 year or so, there's been a big debate on quality, growth, and value. So, where do you stand in that debate, and do you think the cycle is changing there?
I must admit that this quality, growth, value ultimately are joined at the hip. As investors in stocks, you can either make money or you don't make money. But having said that, I would interpret the question in a slightly different way. That I think one of the things that is happening is a change in interest rate regime, from falling interest rate regime to rising interest rate regime. We've been used to a situation over the last 15-20 years of falling interest rates, and we are finally getting into a situation where rates are finally starting to go up. That has an implication on investment style, and the first implication on investment style is the long-dated cash flows. Companies that probably earn cash flows far out in future gets discounted higher, and that's the reason the valuation impact on long-dated cash flows in short growth stocks get impacted a lot more in the rising interest rate regime than otherwise what we've in a regime that we've been used to over the last 10-15 years. And it's a very important point for all of us to understand. I'm sure looking at the audience, some of you would be direct investors, you would have global exposure, this, that, the other. It's very important to understand the implication of this, because at the end of the day, if for instance you have a tech stock which kind of gives you earnings 10 or 15 years down the line, now your cost of capital has gone up by about maybe 100 basis points, the impact on that stock's value is significantly higher than that of a consistent earnings cash flow, consistent cash flow earner which does so over the next 10-15 years. The moot point is that overall growth stocks get impacted more, growth in style gets impacted more, and hence on a relative basis the value as an investment style for sure kind of starts to go up in terms of in terms of the type of stocks that go up. But I think the market today, if you really ask me, is smarter than that. I think on first level thinking, clearly in a rising interest rate regime, growth does badly, value does well, and hence one should move towards value. But as Howard Marks puts it, in the second level thinking overall, one needs to understand the scope of earnings upgrades. And I think as bottom-up investors, that is really what matters. As my friend pointed out, that we are in uncharted territory with regards to macro. We don't know when things will turn. But what we know, if our understanding is correct, of the fundamentals of the business, as to how the earnings will shape up for the companies that we are interested in. And hence, in my opinion, earnings upgrades is the way to think about it. Wherever you have earnings upgrades, valuations will sustain. even in current tough market conditions, I'm talking from an equity market standpoint, in areas, in sectors, in stocks where you have earnings upgrades starting to happen, you are seeing that the valuation continues to hold up and the stock continues to do well. On areas which are higher multiple, but the earnings upgrade ain't happening, that's where we are seeing maximum amount of correction. So in terms of, to answer your question in the framework that you asked, growth, value, and whatnot, I would say that I stand by the side of earnings upgrade. Wherever earnings upgrades are due to happen, that's where I queue up for my stocks, for the stocks that I am interested in. I think that's what, in my opinion, works for the medium term. It has an element of value, it has an element of growth, but in essence, earnings upgrade is what the key is.
Thanks, Tridib. Quite a lot of questions. So before we dive into one question for Amit on the debt side. Over the last 1 year, because the debt portfolios were having a challenge in performance, there were a lot of different selective bond enhancement type strategies which came out in sort of target maturities and all those. So where do you stand with that, and do you think that is a good segment to be in also?
Two points there. The first thing to recognize is whether it was FMPs in the past or target maturity funds now. There are two basic concepts that work there. One, they are fully invested portfolios. So you are not taking a view on the market, you are taking a view at an absolute yield, and you remain fully committed to that portfolio from day one till the maturity of that portfolio. Effectively, so what you end up getting is very close to what you entered in with, and there can be no variations, significant variations around that if you stay the course. Last year, target maturity funds became the talk of the town, if you may, or became the most discussed point between fund managers and investors for a very simple reason. Last year, same time, your repo rate or reverse repo rate, which is the operating rate, was 3.35%. Liquidity in the system was 12 lakh crores. RBI's next rate move was most likely to be a rate cut rather than a rate increase, and there was absolutely no carry at the short end of the yield curve. So even for investors who were looking at some reasonable carry into their portfolios, you had to increase some amount of risk in your portfolios. Now, risk here is more in terms of the tenor of the bond that you are buying. Now, clearly, instead of buying a 3-month bond, if I buy a 3-year bond or a 5-year bond or a 10-year bond, I was getting that requisite premium last year, and that is why this entire philosophy of target maturity funds came in, because the first need that was getting met by those funds was carry. Okay. Then how do you solve for this problem that I want carry, but I don't want too much of risk? Because obviously if you are buying a 5-year paper, the interest rate risk is higher than buying a 3-month paper. The way that problem was solved is by making it a target maturity structure, where I buy the 5-year paper today, but 6 months down the line it becomes a 4.5-year paper, so on and so forth, and then it finally matures, which means that incrementally speaking, every 6 months, every 1 year, the interest rate risk in that position keeps on declining. So A, you started with a good carry. B, you kind of locked in that carry one way or the other if you stayed the course. And C, for some reason if you were required to move out midway for liquidity considerations or otherwise, the more time you spent in the product, the risk associated with the product kept on going down rather than remaining static. And that's why this became very, very popular, right? Come to today's context, all these funds have obviously run fully invested portfolios, have taken the hit of interest rate increases. Just to give you a simple example, last year we ourselves launched a 5-year portfolio which was investing into sovereign instruments, state development loans. When we started investing, the yield was closer to 6%. Today the yield is closer to 7.5%, right? And that is why the 1-year return in that portfolio would not be looking great because yields have moved from 6 to 7.5, the portfolio has got mark to market. But what we need to understand is if you stay the course from start to finish, you will end up making something very close to 6%, possibly slightly higher than that. That's how the product or the structure ultimately works. Right now, while the portfolio has taken the brunt of the interest rate increase in the last 1 year, please remember what we said in the beginning, that a fully invested portfolio works best when interest rates are coming down and works the worst when interest rates are going up. So if we are in a range now where interest rates are looking to peak out over the next 3 to 6 months, then you are better off actually investing to that portfolio or adding on to your investment to that portfolio rather than removing. Because you have lost money on a fully invested portfolio, you need to make money also on a fully invested portfolio, which is what these products offer. The second good news is that many of these products which have started as 10-year or 5-year or 3-year products would have a much lesser duration risk today as compared to what was the case a year back, right? Which means your carry has improved, but your interest rate risk has come down. So to that extent also, in fact, a case could be made on whether you should be allocating more into these products rather than you should be moving out of these products. So that's broadly how I would look at the target maturity segment.
Thanks, Amit. So, we've got quite a few questions, so I'll club it together and first on the macro thing and the big question which is coming, which both of you all avoided to address a bit, was on US recession. What is the risk of a US recession and stagflation, and how will that impact both the asset class, Indian equities and Indian fixed income? So maybe Pradeep.
Recession is an interesting topic. Recession is something that you only get to know backward looking. And the reason I say this, how do you define recession? Recession is basically 2 quarters of negative GDP growth. Now, when does GDP growth data come in? Data comes in at the end of 1 month after the quarter ends. So, 1 quarter negative GDP growth we've already seen in the United States. When the June quarter data comes about, we will see how it looks like. But maybe we will see numbers come about. Yes, the markets have corrected in the United States. But if you look at are things collapsing anywhere around the corner? Yes, there are pockets where overvaluations have sort of come through. Has happened. The stocks have reacted likewise. But it's not that we are going back to anywhere close to the levels that we saw in 2020, there or thereabout. I think the moot point with regards to inflation and overall recession, I would say, I think from the data that I have looked at overall, we see a slowing growth scenario rather than a recession. I am no expert on US economy, but this is what I read across various different publications that I sort of read, that overall growth will slow, but not yet maybe a recession. The second thing that I would say is, rather than focusing on recession or whatever the outcome is, the independent variable to keep in mind on is basically oil price. The data that we kind of see globally is that if oil price is north of $120 for a sufficiently long period of time, which is 6 to 9 months, there is demand destruction that happens. And as demand destructions happen, obviously countries go into recession and bad things happen overall. So to answer your question, whether US recession, stagflation, we will see how that comes about, and we'll come to the impact on the portfolios as next. But first of all, the independent variable that I keep an eye on is basically how long has oil kind of stuck around that 120 plus kind of level, because that's what dictates the rest of it. And to address the worry, if I would say that if come Diwali, if we still see oil at $120 plus, then I think we are in a situation that globally, as well as in India, we will see kind of a demand destruction starting to happen, and moderation in growth across will be beyond a point difficult to digest. We'll get into stagflation kind of a scenario and overall, if you really want to get better. That's not my base case view though. the best case view is that over the next couple of months, you will probably see the pace of inflation starting to come down. You will probably also see the war between Russia and the rest of the world, Russia, Ukraine, so to speak, carrying on intensity. That's a bit of a hope rather than anything else, but hopefully that comes down over a period of time. And the more important part, which is a lot of this inflation, which is ultimately driving this concern on stagflation or recession, is supply driven. The supply is expected to ease out over the next 3 to 4 months, so to speak. So I think we are in a nebulous situation where things are expected to come down. In fact, some commodities like steel, copper, etc., have already started to come down, which gives me a bit of more hope that inflation actually reduces as months come by. And as supply of chips, this, that, the other comes on board, which is again based on data, what we are seeing should come through over the next few months. You will see easing out of logistics costs, etc., which is another reason behind driving inflation. So net, what I am saying here is that if oil sticks around 120 plus till Diwali, we'll probably get into a recession or stagflation, whichever way you look at it. But there are enough and more evidence which goes on to show that in terms of data, that things might actually, the inflation, commodity inflation, supply chain issues, things would moderate by that point in time. So that's how I would think about if you
So to that question, I will actually rephrase that question more in the context of Indian fixed income. So very important to recognize two things. Indian domestic macro is very, very different from US domestic macro, which essentially means that what happens to our economy or our interest rates is much more determined by how we conduct ourselves over the next 2 to 3 years. The US recession obviously matters in terms of global commodity prices and other price pressures that we are seeing right now. But beyond that, as far as the overall macro is concerned, including some of the aspects of inflation that we are seeing in India right now. For example, one of the remarks that RBI made when they revised their inflation forecast from 5.7% to 6.7% recently was that 75% of this increase in inflation forecast is coming because of food. And if you actually look at it this way, food is one of the places where we are self-sufficient in most of the areas, barring possibly edible oil. So the limited point being that does the US recession ease out price pressures on things that are globally traded and globally consumed? The answer is yes. Does it necessarily worsen or improve India's macro and especially India's fixed income? I think that is much more unique to India to be considered in our unique context rather than just looking at the US market.
Thanks, Amit and Pradeep, for that. There are quite a few questions on inflation as well as outlook on gold. So maybe that I'll take by just answering that. So on inflation, we had done one particular study some time back, and we split India's inflation in different regimes between low, moderate, high and very high. Moderate is basically 4 to 6%, high is 6 to 8%, and 8% above is very high. Now, if you look from an asset class outlook perspective, anything below 4%, actually bonds is the best asset class to be in. Historically, it has been proven in a 20-year study, which we did. If inflation, which RBI now is forecasting closer to 6.7%, means it's in the very high period, in that actually equities does well. So equities do well, but it will come to the point which I'll ask Pradeep, large cap does well, mid and small doesn't do well. So there's a clear divergence of performance which is there. Cyclical sectors do well. In bonds, corporate bonds actually do well because it tends to be in a good corporate cycle which we have. And that's where the comes of gold. Gold is an asset class where returns keep on increasing as we go higher the inflation curve. So in case all our views on inflation doesn't pan out and inflation stays higher than longer, then having gold as a portfolio hedge would be very critical. That has been our view over the last 1 year, that have that allocation to gold mainly as a portfolio hedge. Not only if inflation risks materialize more than what any of us are forecasting and seeing, or also for equity market volatility. So that's on the inflation gold outlook which is there. Moving that back to the large cap questions, there's a lot of questions on which part of the segment should we prefer, large cap, mid cap, small cap. In the last 6-7 months, we've seen mid caps correcting a bit more, but large caps have held. Where do you stand there?
The short answer to this question is, I expect the next, 9 months to a year, kind of very volatile time frame. In that circumstances, I would probably kind of think about large cap and as categories, as SEBI has categorized large and mid or flexi. These three categories being a better place to be in because they can time the volatility a lot better, and also with regards to risk appetite, it doesn't give you that much of a heartburn. And what we also see in the case of large and mid, the reason, ultimately as a fundamental investor, why is it that during high inflation times large caps do well? The reason why it is the case is because the large caps have the best pricing power in tough circumstances. So, for companies which have pricing power, basically the issue is less about large cap, though it gets clubbed under that. The main issue is when inflation is high, can you pass it on to your customers without them switching on to the competitor's product? That is the crux of the investment debate. If the company is able to do so, then that's the right investment for you. In the case of large caps, the situation works out better because the large caps on the whole have better pricing power. But I would not probably get honed in on a cap basis. Ultimately, what one has to look for in these circumstances is basically companies with pricing power. In some of our mid and small cap portfolios also, we have stocks which have significant amount of pricing power. Imagine a company which makes pet food, and that's a leader in that category. You can there is none that comes close. It's a mid cap, but it has tremendous amount of pricing power, far better than some of the large caps as well. So during inflationary times, the panacea, so to speak, is pricing power. And areas that are, or segments of the market which have pricing power are the ones to focus on. A rudimentary way of narrowing down of areas which have pricing power is the large cap or large and mid, and that category. Because generally, the larger companies have better pricing power than the smaller companies. But as long as you realize that what one is going for is more rule of thumb, and the real meat of the answer is in pricing power rather than the large cap basis, large or mid or small. There are some companies like luggage makers where you don't have a large cap company, but they have phenomenal amount of pricing power. So the way to tide through from an equity stock standpoint in terms of times of high inflation is actually investing in companies with pricing power. That is how I would kind of answer that question.
Thanks, Pradeep. And moving to Amit on the question of where do you sit between the government bond debate versus corporate bonds? Because even corporate bond yields have spiked quite a lot, and now the spread is not that attractive. But the other point on government bonds is there's a lot of supply. If RBI doesn't intervene, who will be the buyer, which is there? So do you think corporate bonds is the better place to be rather than government bonds?
So I definitely think government bonds is a better place to be than corporate bonds, because if you don't get compensation for the additional risk that you take, then why do you take that risk? Demand supply is something that I think is overemphasized in the markets for the simple reason that from an interest rate standpoint, you are taking a similar risk because we are comparing apples to apples here, right? So ultimately, I don't envisage a scenario in India anytime soon where corporate bond yields will be trading below government bond yields. And if that is not going to happen and the spreads are at all-time low, why would you unnecessarily allocate a higher amount to corporate bonds when government bonds are available at attractive levels and there are no spreads? To take the earlier point that you had actually made about high inflation environment and corporates doing well, I would only want to add two bits here, which is also related to this question. It is true that corporate balance sheets are possibly the best that we have seen from a credit risk perspective in the last 10 years. It is true that people have made a lot of money through operating leverage in between 2021 and 2022. Obviously, that's not going to repeat during the next 2 years because input costs and margins are under pressure. Having said that, we definitely don't see a risk on corporate balance sheets in a manner that was talked about earlier pre-2018 for non-financial services and post-2018 for financial services. But in terms of returns on the portfolio generated, I don't see too many ways in which corporate bonds could be outperforming the sovereign curve in the near term. Unless you are seeking out a much higher degree of risk and you are getting much higher compensation for seeking out that degree of risk, which is a very different way of looking at the corporate bond. So you're no longer talking about AAAs and AAs, we are talking about the BBBs. Not that all investments there are bad, but you are seeking out a certain level of risk and you are getting compensated for that. That's a very different ballgame altogether.
Thanks, Amit. Maybe one final macro question before we go to segment specific questions. On the rupee, there has been, where do you see the challenge? Because especially with oil price being so high, people would have expected the rupee to be much lower at this juncture, but it has stayed quite stable. So any views on the rupee and how do you see the impact both on equity market and fixed income, which is there? And there's a follow-up question just on the equity part, because we've seen huge FIS selling, which is there. When will that stop? Because other EM markets are literally non-investable. Still India is seeing a lot of outflows.
So let me take the second question first, overall. And before I answer this question, just to kind of put the data in front of all of you, since October of last year, the amount of money that FIIs have withdrawn from India as a percentage of India's market cap is the same, it has been the same as they did in 2008 overall. So overall, but with one big difference, that in 2008, markets collapsed by 60 to 70%, whereas this time around, markets have been hovering around in a range of -5 to -10%. So that is, the base data point is the same, but the outcome is different. And the outcome is different because for the first time, we are seeing local investors, whether it's HNI, retail, etc., coming to the party and increasing their equity allocation overall over time. I think this is actually more structural in nature. So, in my opinion, if you look at the number of accounts being opened in Zerodha or some of these online brokerages, fine, some of that is technical, will go down. But over a period of time, the awareness within equities amongst the local investing fraternity has certainly gone up notches courtesy during the COVID times when not many things were open. I think that is structural and that will stand to come through. So overall FIIs, which were roughly about 22 to 23% of the market, are now down to somewhere around 19 or 20. Historically, we've seen that once it grows to below 17, they usually stop. But I wouldn't pay too much attention to that. I would probably guess that once this rate increases overall, there is some stability around the rate increases as to where the rate increases will settle. You will see the FII, probably flows stabilize. The other answer that I would put forward in front of you is that imagine you are an FII portfolio manager, and amongst your emerging markets portfolios, and you get a reduction. Amongst your emerging market portfolios, there is only one or only a handful of countries that have done well, where you can really take profits from. Whether you like it or not, that is India. And hence, there is some bit of money being chipped off on the side from just to kind of get some profits out. I talked about in my earlier part of my prepared comments that today India is trading at somewhere around 25 to 30% premium to some of our Asian players. That has also got to do with it. But the fundamental premise that fundamentally India in the global context is looking a lot better spread out as opposed to what we are using earlier should not be forgot. So in my opinion on net balance, I would say that fundamentals in India in the global context for the first time are looking quite constructive. Overall, the FII outflow has been slightly more technical than otherwise. Call it outperformance, call it weightage in the index going up and all that kind of stuff. But I haven't come across people who are die-hard negative on India, so to speak. The only deterrent is the valuations on relative course are higher. And I think overall, as that evens out over a period of time, you will see that come by. So a verbose answer to your question on FIIs. Rupee. Now, quite frankly, commodity markets are tough to predict. Currencies are even tougher. So I would say that I understand actually the relative resilience of Indian currency because the macroeconomic or rather macroeconomic situation in India is not, in my opinion, better. If you recall in 2014-15, we were considered part of the fragile five, where risk on currency and various different parameters were extremely high. This time around, our fisc as well as our current are kind of under control. It's getting worse, but it's relatively under control. This is the difference between how maybe the current government or the current macro environment in India stacks up versus what we have been used to over the last 15-20 years, and there is a market difference in the positive direction. So that explains why on a relative basis the currency hasn't collapsed. And I think there is room to believe that on a relative basis it might continue to remain relatively strong. I'm not a currency expert, but am I betting on today on currency going down? The answer is probably not. If it weakens in the course of on a short period of time, it can stand to happen. But I think on a macro basis, I would say the macroeconomic outlook on India is a lot more stable, and hence the currency outlook would be relatively stable as compared to what we see in other markets. So that's how I would think about it.
So Amit, you are the fixed income expert, so you would definitely have a view on the currency and how you see it.
In the normal course, given your current account position right now, it is but natural to expect some depreciation in the rupee from a more structural sense. Whether it will relatively underperform or relatively outperform is very difficult to put across at this point. The fact of the matter is that if you are comparing against US and US dollar per se, US is one of the few global economies which has still shown and continues to show a respectable growth trajectory. You are comparing your currency against their currency, so obviously that is what matters. Maybe we might end up doing much better than some other countries where the macro imbalances are worse than us. But if it is purely against the dollar, given the current account position that we have, one would normally assume some structural weakness going forward. Not saying that we are anywhere close to 2013 kind of scenario. That was a very different combination of events that came through. This is a very different combination. India is ultimately regarded as a growth economy. Money comes into India not as a safe haven but because of growth. And as long as in nominal GDP terms you are one of the fastest growing economies in the world, that kind of risk does not exist. So obviously structurally you will depreciate because your current account issues are now at the 4, you are going to cross 3% this year. So we have to be prepared for that. Maybe regular years you may see a 3 to 4% kind of a number baked in. This time around, it may be a percent or two more than that is how it will look at it, without knowing anything more about this case.
Thanks, Amit. So few sector and specific questions, Trideep. One is, where do you see the entire IPO market that has fizzled out recently? So on that. Second, on the EV cycle, that theme has also underperformed recently. Are you all positive on the EV space? And in your opening comments, you had mentioned about capex. Which sectors could benefit from this entire capex cycle which we could get?
So, what was the first question again? IPOs. You know, IPOs at the end of the day are a cyclical phenomenon. Let's understand this. When things are good, you have the number of IPOs increase, and then it finally comes down. And fundamentally speaking, you know, IPOs ultimately bring new companies to the market, but at the same time, kind of the information asymmetry that they have, because earlier they were unlisted, now they are listed, is extremely high. So we invest based on you know, information asymmetry, which is quite prevalent at that point in time. So my general thought process on most of the IPOs has been to be careful and kind of, you know, look through doubly or even more than what you see in the listed space. Having said that, I think overall from the pipeline that we are seeing, because we do have a recently listed IPO fund, which is quite popular, and from that perspective, the pipeline that we see is actually, whether you believe it or not, in the short term may be small, but over the year or so, the number of companies lined up for IPO is similar as compared to what we saw last year. So on net balance, I think by and large there is recognition amongst the promoter community that what we are seeing is a lot more transient and will actually go away as we get to the second half of this year. Generally, IPOs are seen as a sign of buoyancy in the economy, and I think the sectoral spread that we see kind of is tantamount to that. The only thing that I would highlight in the difference in terms of the profile of the sectors that have come through is, if you look at last year, a lot of new age companies kind of, you know, came to the market at lofty multiples, and some of them with long dated cash flows that will hopefully come through at some point in time. I think what we are seeing is that population or that segment of the IPO market kind of gotten impacted, and that ain't coming back. And the reason why that ain't coming back is not just in India but globally. Interest rates of about 25% of the global market went negative till about September, October last year, which means that some of those private equity funds could fund some of these projects which had long dated cash flows happily. Because otherwise, you know, they are not getting any return on their money that their core funds are getting. Today, that scenario has changed. Now, with the increase in interest rates, by and large, even the German and the United States yields have actually turned positive. So, on net balance, they do have some yield making without taking too much risk. I think that part of the capital, which earlier used to fund risky projects which have long dated cash flows, some of them fall in the new age IPOs bucket, ain't coming back. I think that segment of the market is probably struck, and probably struck for good. That is not to say that good projects will not get funding, even though with the long dated cash flows, but generally people, while allocating capital to those kind of companies, today in the current circumstances of rising interest rates, would be a lot more careful than what they have been over the last 5 to 10 years. So that's how I would think about the IPO market. What was the second one?
On EVs.
EVs. I think, you know, in a very broader context, ladies and gentlemen, I must tell you that we live in an age of disruption. Period. Now, I haven't, over the last, 5-10 years, I haven't seen a similar. I mean, if you let's put it this way, if you look at the history of markets over the last 50 years, the amount of disruption that we have seen in the last 2 years has been the highest that we have ever seen. across sectors. So a sector which is autos, which has remained the same for the last 100 years since Mr. Ford drove this car, is also seeing a change. Another old, so-called old economy sector like energy, we are seeing renewable energy coming about, and the dynamics of energy sector is also changing quite materially. Old companies like that of Thermax are now talking about investing in new energy. EV is a similar disruption that is happening in autos. In across the board, if you look at last 2 years, I'll give you one example. Another sector, I'll come to this answer. But if you look at retail, okay, now in United States, which is a developed market, okay, it took about 25 years for online retail to go from 0 to about 15% of the total retail sales. Okay? So it took about 25 years for online retail to come mainstream, to become from 0% of sales to become 15% of sales. Okay? And then in the next 2 years, which is the years of this lockdown, it went from 15 to 30. Okay? So it effectively added another 15% to sales in a matter of 2 years. So that is the extent of disruption that we are seeing even in developed markets and across sectors. So in that context, EV is a bit of a long-dated risk. So what I mean by that is there are certain barriers which we need to kind of go through before we see EV materialize. The first thing that we need to sort of that needs to happen is battery infrastructure, and that is not just in India, globally. Okay? And today, while different countries are at different stages of this development, net we are still not there. We haven't figured out the battery configuration as much as we like to believe. So that's number one. Number two, overall, with regards to the government funding towards this EV, has also been a little kind of on the ground a bit different from what they promised. So as a result of this, the EV adoption, while in principle looks no-brainer, will take a bit of time. Globally. But having said that, is the disruption not happening? It is happening in a major way. If you look at two-wheelers, for example, in India, don't be surprised if in 2 years, say in 2 years' time, you see majority of the fresh sales of two-wheelers becoming EVs. So the other way to answer this question is in segments, the EV penetration is kind of really is happening at a very fast pace. In other segments, it's been kind of like four-wheelers, this, that, the other. It is relatively slower. How some of these companies kind of find a way to equity markets and we find a way to make money out of that remains to be seen. I mean, in the context of listed markets, which ultimately the focus of interest is for myself, we haven't seen a pure EV play, so to speak. And none of the incumbents, automakers, have been in a situation that we can say that they will really be leaders in EV. And if you don't get this point, think about it. In the ICE engine age, about 25 to 30% of the auto's value actually resides in the engine, right? That is where automakers invest. But that dynamic completely changes in the EV regime. About 40% of the automobile's cost is just the battery. So the battery manufacturer becomes the the pole point or around which the automakers will have to kind of develop a moat around. This is a significantly different and difficult challenge for the listed automakers to have, and that is the reason why EV adoption, while on paper makes a lot of sense, it will take a lot of time for existing or incumbent OEMs to really move on in that direction. Because to kind of, if majority of the value shifts, all of a sudden the complete value chain moves around certain different companies. So hopefully this verbose answer gives you not just answer to this question, but also gives you a sense the extent of disruption that auto industry, not just in India but globally, it is saying so. So net, for all you know, the highest valued auto company in 10 years' time might be a battery manufacturer. because that is the crux of the value of the EV. Whereas traditionally what we are used to is the engine maker, which kind of takes the majority of the value. So in other words, it's a difficult subject, a lot of moving parts to it, and the adoption in segments is happening at a fast pace. But if you ask me, or put all things in total, then I think it will take about 10-15 years for us to kind of move in that direction. The final bit that I would say to confuse you deliberately is for all the investment in the EVs that the world has done over the last 5 years, that is one of the reasons for high inflation today. Why? Because for all the noise, not noise, rightful noise, that we are happening on climate change, ESG, EV, this, that, the other, meant that over the last 5-10 years we haven't invested at all in fossil fuel. And that's why when Russia turned off the tap, all of a sudden, oil price spiked up. And it's causing inflation across the globe. So, I think ultimately all of these things ultimately fall in order over a period of time. So, near term, much as we see inflation come through as a result of too much of talk about ESG and climate change and invest into EV and whatnot, the near-term challenge is that we do need fossil fuel to sort of run us through for the next 10-15 years. So it's a complex subject, very debatable topic and whatnot. And I deliberately gave multiple aspects to this for you to appreciate. There is no one-strand answer to that question.
Thanks, Pradeep. So, Amit, on debt, especially in a rising interest rate environment, how do you see two segments specifically, the dynamic bond segment and the floating rate segment?
By definition, the dynamic bond fund is supposed to reduce risk in an environment where the market has not fully priced in potential interest rate rises. It is not supposed to follow the RBI in terms of rate hikes, but it has to make sure that whatever are the potential rate hikes, they do get priced in reasonably well before you increase risk in your portfolio. I would think that over the next 3 to 6 months, as that gets more internalized by the markets and whatever residual price risks are there to get taken care of, dynamic bond funds across board would have a tendency to increase the duration risk in their portfolios. And definitely if they are able to do that in a reasonable time frame, they might deliver reasonable returns for investors going forward. Floating rate bonds are slightly trickier. I will leave it by saying that there are two things that should work for a floating rate bond to perform. First, let us realize that when we say a floating rate bond is less risky than a fixed rate bond, we have to compare apples to apples. So when we say a 10-year floating rate bond is less risky, we are comparing with a 10-year bond and not a 1-year bond. It might still be riskier than a 1-year fixed rate bond. So that's point number one. Point number two, theoretically speaking, a floating rate bond is supposed to give you nothing more than what a longer tenor fixed rate bond is going to give, because that's what is the essence of a floating rate benchmark. The floating rate benchmark, when interest rates move up, keeps on moving higher. When interest rates move down, keeps on moving lower. But the job of the markets is to anticipate that and position the longer bond already, realizing that interest rates are going to move higher or lower. So if a floating rate bond is just going to react to RBI rate hike that the fixed rate bond has already priced in, how is it going to outperform? So the way investors have to look at floating rate bonds is as follows, that floating rate bonds offer lower risk if you are comparing apples to apples, which is a 5-year floating rate bond versus a 5-year fixed bond, or 10-year floating rate bond versus a 10-year fixed bond. And two, the only time that a floating rate bond can actually make more money in a fixed rate bond is when you have unanticipated changes in interest rates, not when you have anticipated changes in interest rates. So if you are just looking at a floating rate portfolio to reduce your risk vis-a-vis a similar kind of fixed rate portfolio, then that's the solution for you. If you are looking at a floating rate fund from an outperformance perspective, over the life of the floating rate bond versus over the life of a fixed rate bond, very difficult to come by.
I missed that capex question that you had. Let me quickly sort of cover that through overall. This time or this profile of the capex rebound would be a bit different from what we are used to earlier. This time around, the bigger demand driver would be renewables, would be in data centers, in infrastructure centers, whereas earlier, and some bit of it would be kind of steel and the traditional sectors as well. But overall, with regards to the majority of the capex cycle, in terms of the drivers of that and which sectors that will come from, it will be materially different from what we have come through. So, the rhymes of this particular this particular capex sector will rhyme quite well as opposed to what we are seeing in the last 10-15 years, but will be different because today majority of the demand is coming from as I was talking about the energy mix shift from traditional to renewables. In terms of data, migrating towards cloud, more towards data centers and stuff like that. So I thought I'll just cover that. Thank you.
Thanks, Pradeep. Thanks, Amit. And thanks all of you all for being a wonderful audience. There are still few more questions, and the one question which maybe was not addressed here, which a lot of asked, is how markets have been very volatile. How should I do my asset allocation? And that's what we are here at Standard Chartered. I'll just leave with one snippet before I hand over to Piyush, is that last year it was all a FOMO market, fear of missing out, where people felt if I didn't buy the new age IPO, I would miss out. This year, what as investors you should avoid is FOMO, which is the cost of missing out. Just two data points. In a 25-30 year, if you do a market study of Nifty and Sensex, your returns come up, if you're invested throughout, come to 12-13%. If you miss even 15 days, that return falls to 8%. And you miss 30 days, your return is lower than debt. So it's very important to stay invested. And the second is your best days are always coinciding with the worst days. And that was proven in 2020, where March 23rd, you had a 12% fall. And one of the biggest rallies you had was the next day. So you cannot time the market. And that's where asset allocation helps. And with that small snippet, I'll hand it back to Piyush.
Thanks, Vinay. Thank you, Tridip, Amit, Vinay, for your thoughts and valuable inputs on the way forward. Ladies and gentlemen, on behalf of Standard Chartered Bank, we would like to express our gratitude and heartfelt thanks for each one of you who has taken time off your busy schedule on a Friday evening to join us today. May I request you all to join us for dinner and drinks. Thank you once again and have a good evening. Thank you.
Sorry.